Hey traders, welcome to video 5 of the Forex Beginners course. This is Corey Mitchell. In this video we are looking at the spread, swaps, and market hours. Three things that can be a little confusing for new traders, and we're going to look at them in this video, brought to you by Investo.com. So Forex is a 24-hour global market. That means it's a network of a whole bunch of different banks, institutions, traders that compose this market, which doesn't have a central location like, for example, the New York Stock Exchange, which has an actual centralized location. The Forex market is a global market, and it's basically just a network of everyone buying and selling from each other. So this creates a few oddities compared to other markets. The spread isn't really any different than other markets, but it is something that a lot of new traders find a bit confusing. So the spread is, there are always two prices in a currency. There's the bid and the ask. So the bid is where people are buying, and the price that you need to sell at if you want to get rid of your position. So those people are going to be buying, let's say at, if we just use real simple numbers, people are buying at 1 and people are selling at 2. So if you want to get rid of, if you have a position and you want to get rid of it, you're going to have to sell to those people who are willing to buy at 1. Or your other option is to put out what we call an offer. So you're going to join the people at selling at 2 and hope that somebody fills your order. We'll look at how that works in just a minute. The offer is where people are willing to sell and the price that you would have to buy at. So we have those people selling at 2, and if you want to buy something, you're going to have to buy from the people who are selling. So for each transaction, there's always a buyer and a seller. So you can either sell to the people who are buying at 1, or you can buy from the people selling at 2, or you can put your order really anywhere else that you want and hope that somebody fills it. But if you want to get an instant execution, you're going to have to give the people the price that they're asking for. So the difference between the bid and the ask is called the spread. With most types of accounts, the spread is about 1 to 3 pips you're going to find between brokers. For the USD, for example, the most popular and most liquid pair, you're going to find spreads usually around 1 pip. There's typically no commissions charged in Forex trading because the broker is going to make money off that spread. The actual spread that they can achieve is smaller than the 1 pip. So by them charging you 1 pip, they're marking up the price a little bit. So that's how they make their money. They're what are called ECN accounts, which is where you're going to pay a commission. So on my ECN account, I pay about $5 for each 100K that I trade. But there is no spread, or it's extremely small. So you can pay a commission and have very little spread, or how most accounts work is you're going to pay a bit of a spread, but you have no commission. So let's see how that works. I have a little plug-in here which shows what the current bids are and the current offers are. So you can see this is the current bid and this is the current offer, and you can see people stacked up at different levels. So you can see how much currency there is. So if we switch that to quantity, we can see how much money is at each one of those levels. And it'll fluctuate constantly, so you have people stacked up moving at a higher price. So these people are offering and these people are bidding, and it starts low and progresses up to the current price. So these are people that are willing to buy, these are people that are willing to sell. If you want to buy right now, you're going to have to pay this price because that's where people are selling. You can bid at this price, but you're not guaranteed to get into a position because one of these sellers is going to have to drop the price to get to your order. So these guys are all just waiting down here for the price to drop and for their order to fill. These guys are all sitting at a higher price, hoping that the price rises and then they can get out or get into a position sell at a higher price. So these guys waiting to buy at a lower price, these guys waiting to sell at a higher price, and any transactions that are going through. So each time the color kind of changes, the transaction's going through and someone is getting filled at the current price. So that gives you a visual of how the bid and the offer work. And you can also see the spread here. This is not an ECN account, so we can see the spread fluctuating at around a pip. So this is just a general account, and you'll typically see this. Some brokers, their spreads are going to be a bit bigger. Others, this one's probably the smallest you're going to see for a non-ECN account. Others are going to be a bit bigger, around 2 or 3 pips. So a lot of brokers offer a plugin like this so that you can get used to seeing how the bid and the offer works. This is just called a level 2, and you can see that level 2. And it also allows you to put out orders and stuff like that. So if your broker does offer a plugin like that, it may help you visually see how the spread works and how you're going to get filled. So you can kind of see, if you put out an order, you'll be placed in this queue here for people who are waiting to get an order filled. So the next thing we have to discuss is what we call swap or rollover. So different countries have different interest rates. If the US has a 0.25 interest rate in their country and Australia has a 4% interest rate, there is a 3.75 interest rate differential there. So Australia has a much higher interest rate than the US is offering. And this is determined by the Federal Reserve in the US and other central banks in other countries. So when these announcements come out, they are big. So when you look at an economic calendar, you'll see daily events, and these are big ones because interest rates determine this swap and rollover each night. So what is that? If you're long the Australian dollar, so let's say you buy the odd USD, you will receive a credit daily for this interest differential because you own a currency that has a high interest rate compared to the other currency in the pair, which has a low interest rate. So you are going to receive a credit for that interest rate differential. But if you take the other side of the trade, so you go long the USD and short the odd, so you are short the odd USD, you will be debited the interest rate differential. So if you buy the higher interest rate currency, you're going to get the interest rate differential. You're going to be credited. If you buy the lower currency interest rate, you are going to be credited or debited each day. The swap occurs at 5 p.m. Eastern Time. So no matter how long you've had the position, you're going to be credited or debited at 5 p.m. So you can potentially sort of, I guess, game the system if you wanted to. You could buy the odd at 4:59 p.m. Eastern Time, 1 minute before the swap, and you would be credited with a tiny little debit into your account. It's probably not worth taking a position for because the potential gain or loss on the position is going to be much bigger than this interest rate differential. But no matter what time you buy it at, or what time you take your position at, every day at 5 p.m. you are going to be credited or debited, and you'll see it pop up in your account. Brokers typically take a cut here as well, so it's not going to be exactly the 3.75% in this case. Also, this is over a year, so you're not going to be credited with 3.75% every single day. You would be credited with approximately 3.75% divided by however many trading days we have in a year, about 220 or so. So it would be that divided by 220, so it's quite a small amount each day. So we can see the current swap in MetaTrader. So here's just MetaTrader. If we pull up our Market Watch, we can see all of our pairs. we can go to symbols, and it'll bring up all our symbols. We can click on anything, any pair that we want to see. So the AUD USD, that's the pair we were discussing. So the Australian interest rate currently is higher than the US dollar. So if you buy this pair, the AUD USD, you're going to make a little bit each day at 5 p.m. If you sell the AUD USD, so you're short the Australian dollar, then you are going to be debited each day at 5. So just click on properties, and we can see what that actually is going to be. So it says here contract size is 100,000. So that means it's giving us this for a standard lot. So if you buy $100,000 worth of the AUD USD at 5 p.m. swap long, you are going to be credited with $4.59. So just for holding that position, this is in addition to whatever you make on the actual trade, the fluctuation of that currency pair, you are going to be credited with $4.59. So if you only had a $10,000 position, you would divide that by 10. So you would make 49 cents or 45.9 cents. If you have a $1,000 position, you're going to make 4.59 cents. So it's generally not a huge thing. You probably don't want to take positions solely based on this, but it is something to keep in mind. For a contract size of 100,000, if you are short, so that means you sold the AUD USD pair, that means you've sold the Australian dollar, the higher interest rate pair, or the higher interest rate currency, you are going to be debited $7.79. If your position is only $10,000, you're going to be debited 77.9 cents. If your position is 1,000, you're going to be debited 7.79 cents. So that is how that works. This is just a demo account. So if you open up your thing, you're going to see a swap here. So if you have a position, the swap is going to show up in this column at 5 p.m. Eastern Time. So, and then it'll just accumulate until the position is eventually closed. So you'll see your profit and loss on the actual position and also your swap. So in that case, if we go back to the Australian dollar, so if you're long the AUD USD and you have a position in it, you are going to see a swap of $4.59 pop up here at 5 p.m. Eastern Time. If you're short, you're going to see a debit of 7.79. So market hours is another one. The market is open 24 hours during the week, starting at 5 p.m. Eastern Time on Sunday night, and it closes on 5 p.m. Eastern Time Friday evening. In between that time, it's open 24 hours. It trades 24 hours because there's always a market open somewhere, which means there's banks and institutions doing business and providing liquidity and needing liquidity. So here is, if you just go forexmarkethours.com/markethours.php, you'll get this little pop-up window, and it shows you the major market hours, and you can change your time zone to whatever. So I have this set to New York time, and you can see the current time here so that you can check it to make sure that it's accurate. Then according to that time, it'll convert what the market hours are for this time frame. So in Eastern Time, this is when all the markets open, and you can see there's always one market open. So New York closes, Sydney opens. While Sydney's open, Tokyo opens. Tokyo stays open until London's open. So during the week, there's always one of these open. So starting on Sunday night, Eastern Time, Sydney is the first one to open at 1700, which is 5 p.m. Eastern Time. So it stays open, then Tokyo opens, then London opens, then New York opens. They all trade throughout the week, and then finally, come Friday, New York is the last one to close at 5 p.m. Eastern Time. So 24 hours a day from 5 p.m. Sunday to 5 p.m. Sunday to 5 p.m. Friday. So we can see these different markets open, the different times that they trade. Let's just keep that up there for now. So if you're day trading, you want to trade in pairs where at least one or two of those markets in the pair is open. For example, the Euro USD, when either London or New York is open, that's when you want to trade. So we can see here, London opens here, so this is when you could start trading the Euro USD, and you could trade it through till the end of the New York session. When both these markets are open, in this section here, you're going to have a lot of volatility and a lot of volume because you have two big markets trading that pair. Outside of that time frame, so when Sydney's open, Tokyo's open, you're probably not going to have as much volatility or trade-worthy moves in the Euro USD because none of those, the markets that really trade that pair aren't open. So another example is the USD JPY. So that's the New York US dollar and Tokyo, which is the yen. So these are open at different times. So the USD JPY, you're probably going to want to trade while when New York is open or Tokyo is open. During these dead times in between when those markets are open, it's likely to be very quiet. And we can see this at VantagePointTrading.com/daily Forex stats. Up there you can quickly see volatility studies. So here is the Euro USD. We can see this is in Greenwich Mean Time. When both those markets are open, we see a lot more volatility. So this is the number of pips that we're moving in terms of, this is hour of the day. So when these markets aren't open, very low volatility, very low volume as well. So we're going to mostly want to trade, if we're day trading, during this time here, which is when those markets are open. The USD JPY we'll see a little bit different. It's more volatile when US is open, a little bit more when Japan's open, and kind of tails off when those markets aren't open. So we're going to want to focus on day trading when the markets within our pair are open. If we're swing trading or taking trades that last more than a day or so, then it doesn't matter as much. We can take positions just whenever we see them. But for day trading, we're going to want to focus our efforts on pairs that has a market open because there's just going to be more movement, more volume. So those are those three concepts. Important to understand. Go over them. If you're still unfamiliar, watch the video again. Play around in MetaTrader to get used to looking at what the swap is, the spreads, and get used to the market hours. Until next time, happy trading.